annualized rate of minus 28% in real terms. It makes it a bit worse than earlier figure of minus 27.8%.
That every state market right now is different, every country is different, and they're adapting and changing dramatically.
Kospi index is close to erasing its year-to-date losses, jumping about 50% from its March low as of Tuesday. Fueled by a recent market bull run, outstanding margin loans, which investors take out to buy.
Economic downturns are pretty much inevitable as time goes on. Unexpected times of crisis like pandemics and wars arise, causing drastic changes for everybody across the globe. Is there anywhere we can invest our money in during these times while still putting food on the table? This is Business Explained. To learn more about all things money, get educated about how to do business, become business savvy, and enjoy more videos like these, subscribe to my channel and click on the notification bell, and may you be granted with many sweet returns. When you think of the word investment, especially for those of you who haven't approached the field before, I'm guessing your brain might immediately connect it to a totally different world of economics that's out of your reach. But don't worry, investment is a legitimate avenue for income where you simply direct a portion of your personal money towards a certain asset which has the potential to grow into something more than what you put in. But this avenue does require a certain level of knowledge so that you can play your money in a smart way. So what is there to know before knowing where you can invest your money during a recession? As I mentioned earlier, we invest in what we call assets. Assets are basically anything that someone owns that has or produces value. Assets are either liquid or non-liquid in their nature. Just think of things you own already. Generally, cash or anything that can be easily converted to cash and doesn't lose much of its inherent value when moved around are considered as liquid assets. Cash that's on hand, held in a bank account, or invested in stocks or mutual funds are a few of the examples of liquid assets. Non-liquid assets, on the other hand, are things that can't easily be converted to cash without losing significant value or time. Examples of these are things like your car, your guitar, or your house. Compared to liquid assets, the amount of time it takes to gain the ideal buyer of what you own usually takes more than 1 week, sometimes months even. So why is this something to take note of? All of the different kinds of assets have their own demand in the market determined by people, so it's not necessarily that one is always better than the other. It's important to ask yourself then, if during times of less stable income and even possible losing that source of income, are you financially stable enough to be able to set aside a portion of your money to invest? It's also important to be realistic to yourself on the clear goals you have financially. Let's say you've got all these things covered and you know where you are in your confidence for investing. Let's assume even that you're already in the investing world, but then the recession hits your country. You notice investors around you backing off and taking off their investments because of the amount of loss and the uncertainty of when things will grow again. Is there anywhere to even invest in with a high chance for growth or financial return despite the economic setbacks? There is, but which cards are the best to play? There are many different kinds of assets one can invest in, sometimes called investment vehicles. These are the things you already probably always hear in movies, the most common being the 3 general types: stocks, bonds, and mutual funds. Let's go through each one of these and see what specific assets you can invest in. The most famous you'll always hear are stocks, also known as equities, and these are basically a compilation of assets called shares, which represent ownership of the company you want to invest in. You can consider a share as a unit of ownership to a specific company. Generally, when you say you're invested in stocks, this can mean having invested in shares in one or more companies. Stocks are basically assets where people invest their money because of their projection of how well the company or companies are going to do and how they'll continue to grow and produce more value. How do people earn through stocks though? We have what we call income for capital gains and dividends. Capital gains are the main source of outcome from investment that people look for. If a company is thriving and doing well in terms of how it's performing in the market or how more people are investing their money in it, the original price to which you have to pay to invest in the company's stock increases. This implies also that now the amount to buy a share, or what we call the stock price, increases since the value of the company has grown. This means that those who originally invested in the company now have capital gain because if they sold their share of the company to a different investor, they would earn more money since the original price they bought the stock is now lower than what it's currently priced at. Dividends, on the other hand, are rewards for investing in the company that, since a company did so well over a particular period of time, they set aside a percentage of their financial profit for their investors. There are a few common successful strategies in investing in stocks. The first common successful strategy investing in stocks is known as growth investing. This is one of the strategies more known by many where it's a medium or medium-long-term investment in companies that have a steady or rapid amount of growth in stock prices as time goes on. The second strategy is what we call value investing. As their names imply, growth investment concentrates on the results of a stock's performance, while value investment focuses on the specific value of a stock and seeing if that specific stock is being undervalued, which is seen as an opportunity to take. Both of these strategies have some similarities, such as how they both emphasize the importance of knowing, understanding, and believing in what the business offers, where you can be fairly confident in the projection of its performance over a certain number of years. The difference, however, lies in that growth investment looks towards small businesses or startups and market the value of their stock, meaning that growth in the price of that stock would signal opportunity for investors. Value investments, on the other hand, doesn't look at growing stock prices, but as a sort of opposite, looks instead at stocks from medium-sized or large enterprises that are being sold lower than their actual intrinsic value. Value investing for smaller businesses is also a strategy. The third most commonly used strategy is what we call index investing, particularly passive index investing, which is counted as the least risky way to invest while still being able to grow your money. For this type of strategy, an investor does not need to be fully immersed in knowing the business or other specific factors to consider, because they divide the money they want to invest not just in one equity, but in multiple other investment vehicles as well, such as bonds and mutual funds. Stocks are considered to be the riskiest and most volatile among the options people have for investing because it relies on the market economy heavily and requires an attentive watch on the market, but can also have the strongest yields and value if invested the right way. Now, you might be someone who would want to have less risk in your investments and are satisfied with not having an overwhelming success in producing value. This is where the other two common investment vehicles come in. In stocks, the investor puts their money at their own complete expense, relying on the performance of the stock since they are now part owners of the company. But with bonds, the investor, or now called the bondholder, essentially lends money to the government and or corporations who are considered the bond issuers. For the purpose of funding more of the capital, these institutions need to grant more of their projects or growth. With bonds, the government or the corporation takes your investment and keeps it for themselves until a certain date of maturity where they will pay you back what you invested in full. In return for waiting for the bond to mature, the bond issuers pay you what's called a coupon rate, which is an interest amount from the investment you made. Now, I mentioned earlier a strategy called index investing, where an investor divides the money they want to invest not just in one equity, but in other equities as well that they see fit. This strategy is highly connected to the last type of investment vehicle, which is what we call mutual funds. In its simplest explanation, mutual funds are basically a pool or portfolio of multiple assets being invested in where, instead of you managing and taking care of the investment like you would in stocks, you would have a fund manager running what happens with the investments made not just by you, but other investors who are also investing in the same mutual fund. In other words, you and other investors put your faith in mutual funds managers to conduct the strategies and choose which assets they'll invest in using the money from the investments made. Thanks to the overwhelming development of technology over the past 2 decades, the digital age has really been a huge factor to consider in projecting what the supply and demand of the market will be. For just a couple of relevant examples on where investors are putting their money during recessions, such as those brought about by the COVID-19 pandemic, you can notice a trend where what they call stay-at-home stocks are now the focus of investors due to the uniqueness of the situation where the pandemic has forced a big percentage of the population to stay at home and participate in the market still. They're categorized as stay-at-home since much of revenue is now concentrated on areas involving home fitness, leisure, cooking, and especially technology like e-commerce or gaming. E-commerce related stock from companies like Amazon and PayPal have grown at around 49% and 61% respectively for the first half of the year despite the recession. Tech companies like Nvidia, which sells computer processing units, and the widely used video call company Zoom have grown to be of much focus by the market, making their stocks grow 62% and 273% respectively. As mentioned earlier, the attribute of a stock asset can be very crucial in finding the best opportunities of where and when to invest. So with hygienic companies such as Clorox being a clear need in light of the pandemic, it's no surprise that stock was able to grow by 45%. My advice on where it's best to invest during a recession? If you're more on the conservative side in the risk spectrum, go for investing in bonds or mutual funds. Bonds may be relatively medium to long term, and mutual funds may be less influenced by your independence. But the financial gain from these investments have almost definite returns despite the implications of a recession. If you're willing to go past your comfort zone for the sake of high rewards and learn more about the market, invest in stocks. But you must know what specific or types of companies or businesses are what's wanted and needed by the people. There has to be a level of confidence in what the company offers over a certain time period you project. Numbers like the growth percentage in stock indicate that it lacks potential and significant growth. Seeing and understanding the intrinsic value of a company in relation to the market regardless of how it's doing in numbers will be a good guide for you to avoid common mistakes among investors starting out. Another good area for investing would be in commodities, in what I mentioned earlier, which are non-liquid assets. There's a quote shared by many investors counting that cash is king, but there is much value as well for investing in non-liquid assets since they do appreciate in value among many cases in and out of recessions. What are your thoughts on investing? Will you be investing your money during this recession period? Let me know what you think in the comment section below. I'll be responding to all of you who comment within the first hour.